All right, guys, it's Nick with MarketMakersMethod.com. Welcome to lesson 2 of this MarketMakersMethod.com course. And this lesson is we're still looking at the cycle, and we're still going to be focusing on the weekly cycle, on the intraday cycle, on the bigger picture. But what I want to go through quickly is you guys have access to all these slides as well. But let's just go through them quickly, and let me introduce the market maker for those of you who don't understand and don't know who it is yet. So to beat the market maker, right, the market maker is going to induce traders to take positions, right? He's in the business of doing that. Circuited trade, wide range swings. He's going to do down here quick moves. This is where you see those very fast candles. I mean, they'll give you 30, 40 pips in one 15-minute candle. Spike candles, right, with the big pins. News, right? You've heard of news. You've heard of NFP and FOMC, and a terrorist attack happens somewhere around the world, or there's an earthquake or something like that, and it causes price to behave very irrationally, and there's a big, there's big spikes. That is basically market makers hiding their moves behind news events. That's what they do. And of course, hit the stops and clear the board, force you into margin trouble and pocket your money. That's where we get the term stop hunt, is because they're hitting the stops. And we'll get more into that. Market makers can requote you at will. This is the administrative platform of MetaTrader 4, right? We trade on the MetaTrader 4 platform for traders. They have a back-end platform that's specifically for the dealer. And what they can do is they can see exactly how much is in your account, where you're placing your trade, how many lots you have, how many pips till your stop loss till you'll take profit. And if you get in on Euro USD at 1.12, they can requote you at 1.1250. Or they can requote you 5 or 10 pips that's different from the price that you originally entered in. So this is one of the tools that they have, is they don't have to quote you at the exact price that you entered in. They can toy with the spread. They can open up the spread, and they do this when they hit the stop hunts, when it's a London session, and when they hit the stops and they issue second leg or first leg with a pin and they're grabbing orders. All they have to do here is go on their platform and slide this and increase the spread. That way they're making their hand larger and they can grab more orders by pushing price just a few more pips extended to normally where price went and where you see that it went on your chart. Market makers can hold a price level or extend it so that it becomes visible on your chart. What this means is they can assign exactly where the next 15-minute candle or 1-hour candle, where it's going to tap, where it's going to close, where the opening is going to be. If there's going to be a pin to the downside, they can control exactly how the candle looks, exactly where price is going to extend, where price is going to close, open, etc. This is the tool that they use to do that. So this is not all made up. These market makers exist. This is the administrator user guide. This is where there is a book that they teach market makers how to specifically take your money, take retail traders' money. They know exactly who's in margin trouble. 34.1% means that they're almost about to be called out. Margin call is that they are probably down to the last $200 and they're risking half of their account, and their trade is slowly going into negative, and they're about to get wiped out of their account. They're able to see exactly everyone who's at this stage. And eventually what they'll do is they'll analyze their books and see that they can easily take out all these traders here and pocket their money and wait for them to deposit more into their broker. understand that they manage risk against your open positions. So if they will most likely, and a lot of times, a lot of brokers, a lot of dealers will trade against you, and they will manage their open risk. So what this means is that if you are buying on Euro USD, most likely what they'll do is they'll manage their risk and sell against it, assuming that most retail traders lose money in the long run. That most retail traders are suckers and don't understand this business and are taking trades off of trendline breaks and support and resistance. Now, I'm not talking against any of those strategies because I can't, but this is the reality. This is the account manager's desktop. This is exactly what he sees. Everything that we just went through, he can see exactly when John or when Izzy or when Elizabeth places an order, which country, balance, lot size, margin. Right here you have your margin calls. Here you have the name, their login ID, what country, city, their balance, different type of lot sizes, profits uncovered. They can see all of this on their back end, guys. Understand this. And I want to show you this because I want you guys to believe it. This happens. So market makers, they will create their trap moves beginning of the week. This is very important that I teach in understanding the cycle. False move week beginning. This is what it is, Sunday, Monday. That may not always happen Sunday, Monday. But that's the false move week beginning. Beginning of every day, there's a trap move. Beginning of each session, there's a trap move. End of the session, there's a trap move. Notice that at the end of London, going into New York session, they open the spread up and there's more aggressive moves for the dealer to come into New York session, analyze his books, and he'll hit the stops, right? At the start of each session. At the end of the day, notice that at the end of New York session, the spread will open up. It's amazing to watch this. Every day at 5 p.m. Eastern Standard Time, New York time, the spread is going to open up. And the end of the week, they'll trap traders, trap them going into next week so they have volume to work with. So this is some slides that I wanted to show you guys. Now, I'm going to share something else. Now, you guys all received this ebook, so you should have already been looking through this. So this is, you saw this in a previous video that I went through in the first cycle video. But the weekly pattern does not imply the use of weekly time frame, right? So we look at this on the 15 and most specifically the 1 hour time frame to see the levels and the cycle the best. Sunday, here's our accumulation. This is our psychological support and resistance, our PSR, which we box off from the Asian session on the 1 hour time frame. Here's our false move week beginning, more accumulation during Asian. And then we have a stop hunt low, grab all the orders. Stops are getting triggered on weaker long holders. Then we have, this is our anchor peak formation, and we trade away from this for the next 2 to 3 days. You're good to go. This is the cycle. So they did all this work right here. Sunday, drop, Monday, stop hunt low, inducing all these traders to continue taking short positions and eventually issuing a pin or a W formation, bringing the price away from them and trapping them for the week. We have a rise, level 1 of rise, accumulation, level 2, probably another level in here. So this is just one variation of what it looks like for the cycle. Okay? So now I'm going to go into the raw charts here. And let's analyze more. And for the next 25 minutes, let's go through and continue learning about the weekly cycle. And then we're going to get better and better at this, identifying the weekly cycle on the 1 hour time frame. So let's go. So for this, let's take a look, and I'm going to go in with a different pair for this example. So in terms of different pair, let's bring out, for this sake, Euro AUD. Okay, so let's do Euro AUD here. So let's kind of go through this, and let's go through all this. So the way you always want to analyze your charts is in this way, okay? So what we want to do is understand that we're coming from multiple days of drop right here. So we know this, and this looks clear. EMAs are fanned out. You'll see this in the slides that I sent about moving averages, is that when the moving averages are fanned out, that's indicating that we're in level 3. And that we're approaching level 3, or that we're completely oversold, and that price must return to the baseline. Okay, so now if we're looking at this price here and say, okay, so it's around here, right? We have our PSR right here. So let's go how we're going to analyze this, right? So we always take a look at it. So November 9th to the 12th, right? We take our Asian session and we draw the PSR. Okay. So in terms of what happened here is, this is our anchor because we had our, okay, so previously what we look for is, okay, let's find the peak formation here, actually. Peak formation is identified always. So I'll go in through this with you. But peak formation is always identified by head and shoulders pattern. Okay? Come here, our false move, week beginning, right? How do we know this? Because we have TDI outside volatility band. Come here, second leg, hits the volatility band again. And with this bullish candle, engulfing bullish candle with a pin to the downside there. Can you see that? I'm sure if we go in, this is on November 12th and 13th. Is our PSR. November 12th and 13th, what do we see here? It's a clear. So let's take this. So initially we identified this on the 1 hour time frame. And to further make this valid, what we see here is, okay, number one, the first leg, and then we have our second leg with what? With a pin here, and another pin here, and this is an engulfing, and this forms the second leg. But look at this. The TDI comes here outside the volatility band, and then the second leg back inside with a nice V shape. This is divergence as well. Divergence, what divergence is when price makes, in this case, first leg is here, second leg is lower on the chart, but on TDI, first leg is here and second leg is higher. So the indicator, the TDI, made a higher low. On price, it made a lower low. So that's what divergence is. You can see here, price is moving up on the indicator and price is down on the indicator. That's divergence right here. All these indications you get in right there. By this time, they already shifted the price over 20 pips, and you should have already been in this trade. Now, if we come back and analyze this, go back on the 1 hour. What we had here is also a M formation with spikes exactly at the top of the PSR. Now, understand that when we have our PSR and you read the ebook, our psychological support and resistance. That's why it's called psychological support and resistance. This is the strongest support and resistance that you'll ever see in the Forex market. You don't need to draw any points from the monthly time frame, weekly time frame. Price will, in fact, bounce off of the PSR because the PSR is what the market makers are working with. This is the real support and resistance, okay? So notice that when we start drawing our PSR, our spike candles will spike exactly to the PSR, and we'll see a lot of rejection off of the PSR all the time, because this is where market makers will work price. And this is where they trap their traders, and this is where they made the spread for the beginning of the week. So know that if we come here, and a lot of times what you'll notice is if we have a picture perfect setup, right? So we always look at it in terms of in terms of importance of strategy. Number one is horrible handwriting. Number one is the pattern. Number two is the pattern. Number three is the pattern. Number four is time. And number five is cycle or levels. Okay? So hopefully that's clear right there. So number one, the pattern. Number two, the pattern. Number three, the pattern. Number four, timing. Number five, levels. That's the importance of the strategy. So oftentimes you'll see a picture perfect pattern at the stop hunt box. Look at that, New York session. Pins. And we also have TDI at the volatility band back inside, but we have divergence because the indicator made a lower low, but the second leg on price made a higher high. Made a higher low, and this made a higher high. Can you see that? Right? Price here, price is higher here. TDI here, price is lower here. So anyways, we came back down aggressively. And we came here and issued. That's what is this? A head and shoulders pattern. Shoulder, head, shoulder. Okay? Let's make that more clear. This is your shoulder there, your head, and your other shoulder. That's your head and shoulders pattern. Okay? Now look at TDI. TDI also makes a head and shoulders pattern. Can you see that? So I want you guys to start opening up your mindset and seeing these patterns. There's your shoulder, here's your head, and here's your other shoulder. Notice first leg, outside volatility band. This one's outside volatility band as well, touches the VB. And then the second leg here, or third leg, other shoulder, of the head and shoulders pattern, comes here and just gives us a spike like this. Now, once we have this set and it's anchored, then we wait. Price makes aggressive move up and then consolidates back right here.